Tax implications for Canadians selling U.S. property. Are you thinking of selling your U.S. real estate? When the Canadian dollar was on par with the U.S. dollar, many Canadians bought U.S. property. But now as the Canadian dollar weakens, some want to sell and lock in their gains. In this video, I will discuss the cross-border tax implications for Canadians who are selling a property in the United States. Number 1, withholding tax. As of February 16, 2016, a higher withholding tax will be applied to property sales in the U.S. If you were to sell your property now, the IRS requires the purchaser to hold back 15% of the total proceeds. For example, if your property sold for $90,000 USD, the purchaser must withhold 15% of that sales amount, which would equal $13,500 USD. Number 2, file a non-resident U.S. tax return. Once you've sold your property in the U.S., you will need to report any amount of the selling price that is over the original cost to the IRS, also known as a capital gain. This requires a non-resident U.S. income tax return, Form 1040-NR, to be filed with the IRS. A withholding certificate can be obtained with the IRS to reduce the taxes withheld, so long as the purchase price is less than $300,000 and the buyer will reside in the property. Number 3, long-term capital gains. Long-term capital gains, which receive favorable tax rates, apply to property held for more than 1 year prior to sale. The long-term capital gain from the sale of a U.S. property is calculated based on your tax bracket. The tax rates for long-term capital gains from the sale of property are 0% for the 10 to 15% bracket, 15% for the 23 to 35% bracket, and 20% for the 39.6% bracket. Continuing with the earlier example, if 5 years ago you purchased your property for $90,000 USD and have now sold it for $200,000 USD, the gain would be classified as a long-term capital gain. In this example, the profit of $110,000 USD would be taxed at long-term capital gains rates of only 15% or $16,500 USD. Number 4, Canadian tax return. As a Canadian, you must also report your gain on your Canadian income tax return. In Canada, only half of the gain is taxable, unlike the US. The gain for Canadian tax purposes must be expressed in Canadian dollars using the exchange rate at the time of purchase and at the time of sale. This can result in a huge capital gain in Canada because the Canadian dollar has dropped drastically. Tip: to avoid double taxation, a foreign tax credit on your Canadian tax return can be claimed for part or all of the American taxes paid. For example, in 2011, when the dollar was at par, Joe's U.S. property was purchased for only $90,000. He sold it for $200,000 US in February 2016. With an exchange rate of 1.40, he sells it for the equivalent of 280,000 Canadian dollars. This means Joe has a capital gain for Canadian tax purposes of 190,000 Canadian, half of which is taxable to him at his marginal tax rate in Canada. So here's the tip. If you are a Canadian selling your U.S. real estate, keep in mind the 15% withholding tax of your total proceeds. Once you've sold the property, remember to file a U.S. non-resident income tax return. Also claim a foreign tax credit to reduce your Canadian income tax. The exchange rate impacts the amount of your capital gain reported on your Canadian tax return.